Greetings, everyone. Welcome to today's Liberty Call. It is Thursday, November 17th, 2022. Hope everybody's having a good day out there. It is gloomy and gross here in Colorado. We are having another snowstorm come through. I think it's the third or fourth one so far this season. It's not too bad. It's not too deep out there, but it is cold. Right now, according to my computer screen, it is 20 degrees outside. So chilly, chilly, chilly. All right. Again, another lot of red across the markets again today. So let's go ahead and jump in and see how things did today. Dow Jones finished the day flat at down 0.02% at 33,546. The S&P 500 was down 0.27%, closed at 3948. NASDAQ down 0.35, closed at 11,144. Small caps are down almost 1%. The VIX was down 0.95. It's currently sitting at 2388. Canada was down 0.37. Brazil was down 0.75. Mexico down 0.32. So everything in the Americas was in the red for the most part. Across the pond, one of the bright spots, Germany was up 0.23%. UK down 0.06. France down 0.47. Eurostox was down 0.11. Netherlands down 0.1, Spain down 0.75, Italy down 0.78, Switzerland down 0.17, and Portugal down 1.02. Both Russian exchanges were in the red. The MOEX was down 0.64, RTSI was down 1.03. Headed over to the Asian markets, Japan was down 0.35, Australia up 0.19. Moving over to the Chinese markets, the Shanghai was down 0.15, the SESE component down 0.13, China A50 down 0.98, DJ Shanghai down 0.2, and the Hang Seng down 1.15, and the Taiwan weighted was flat at down 0.01. So like I said, lots of red, not a whole lot of green on the screen today, so not ideal. But again, we're looking at everything in the bigger picture. It is not really surprising. All right, well, let's go ahead and read through today's market recap, see what they have to say. S&P 500 slips as hawkish Fed speaks, stokes deeper recession fears. The S&P 500 slipped for a second straight day Thursday as Federal Reserve officials continued to call for further rate hikes, stoking concerns about a deeper recession. St. Louis Federal Reserve President James Bullard insisted that rate hikes need to be increased further to reach a, quote, sufficiently restrictive level, end quote, to cool inflation. Bullard, who tends to lean hawkish, I like the guy, suggested the Fed's benchmark rate would need to rise to a 5 to 7% range. I can't disagree with that too much. I'd actually probably suggest going a little higher, but the man knows what he's talking about. Signs that the job market remains resilient as weekly jobless claims fell short of expectations, strengthened the prospect of a more hawkish Fed and stoked renewed concerns about a recession. Quote, we had thought last week's increase might have been the start of a gradual move to higher levels, but there was no follow through this week. Instead, claims remain in the historically low range that has held since mid-August, end quote, Jeffrey said in a note. A key part of the Treasury yield curve, the 10-year yield over the 2-year yield inverted, a key recession indicator by the most since 2019. Consumer stocks led the broader market lower, pressured by more than 4% slump in Norwegian Cruise Lines after Credit Suisse downgraded its rating on the cruise stock to underperform from outperform, citing valuation concerns. Norwegian Cruise Lines, quote, has outperformed materially year to date, and we see risks to estimate valuation versus peers, end quote, Credit Suisse said. Royal Caribbean Cruises and Carnival Corporation fell more than 4% and nearly 2%, respectively. Retailers, including Bath & Body Works and Macy's, helped soften the blow in consumer stocks. Bath & Body Works rallied more than 14% after reporting blowout earnings in the third quarter and raising its outlook on the full year. The stronger results were, quote, due largely to better merchandising margin rate and SG&A expense favorability, end quote, Goldman Sachs said in a note. Macy's also lifted guidance after reporting a third quarter results that beat Wall Street estimates on the top and bottom line, sending its shares more than 12% higher. Kohl's Corporation withdrew its guidance for full year, citing macroeconomic uncertainty, though its quarterly results also topped analyst estimates. Following the slew of earnings seen so far in the midst of the volatile macro environment, Goldman Sachs said it favored consumer staples-oriented retailers, including Walmart, McDonald's, Constellation, and Monster Beverage Corp. against discretionary names including Williams and Sonoma. In tech, meanwhile, chip stocks were slightly higher following a slump a day earlier as NVIDIA Corporation's better than expected quarterly results lifted sentiment on the sector. All right, so again, kind of a mixed bag as far as quarterly results and earnings, but these things will happen. All right, next up is housing. U.S. housing starts tumble in October amid soaring mortgage rates. The U.S. home building fell sharply in October, with the single-family projects dropping to the lowest level in nearly 2.5 years as the housing market buckles under the strain of surging mortgage rates, which are pricing out potential homeowners. Housing starts decreased 4.2% to a seasonally adjusted annual rate of 1.425 million units last month. The Commerce Department reported on Thursday. Data for September was revised higher to a rate of 1.488 million units from the previously reported 1.439 million units. Economists polled by Reuters had forecasts starts sliding to a rate of 1.41 million units. Housing starts dropped 8.8% year on year in October. Single-family housing starts, which account for the biggest share of home building, tumbled 6.1% to a rate of 855,000 units, the lowest level since May of 2020. Single-family home building declined in all 4 regions. Starts for housing projects with 5 or more units slipped 0.5% to a rate of 556,000 units. Multifamily housing construction has fared better as soaring mortgage rates force many potential home buyers to remain renters. A key gauge of rents surged by the most on record on a year-on-year basis in October, according to the latest consumer price data. Mortgage rates have jumped in response to the rampant inflation, which has compelled the Federal Reserve to unleash the fastest interest rate hiking cycle since the 1980s. The 30-year fixed mortgage rate is averaging above 7%, the highest since 2002, according to data from mortgage finance agency Freddie Mac. Permits for future home construction fell 2.4% to a rate of 1.526 million units in October. Single-family building permits dropped 3.6% to a rate of 839,000 units. Permits for housing projects with 5 units or more slipped 1.9% to a rate of 633,000 units. So again, not really surprising that the housing market is slowing down with rates going up. It's pushing a lot of people out of their qualifications. So, and that is also why the rental space is continuing to remain strong. All right, next up, the labor data. U.S. labor market remains tight despite technology sector layoffs. The number of Americans filing new claims for unemployment benefits fell last week, showing widespread layoffs remain low despite a surge in technology sector job cuts that has raised fears of an imminent recession. The weekly jobless claims report from the Labor Department on Thursday, the most timely data on the economy's health, suggested the labor market remained tight. That, together with solid consumer spending, keeps the Federal Reserve on track to continue raising interest rates, though at a slower pace amid signs inflation was starting to subside. Initial claims for state unemployment benefits dropped 4,000 to a seasonally adjusted 222,000 for the week that ended November 12th. Economists polled by Reuters had forecast 225,000 claims for the latest week. There has been an increase in layoffs in the technology sector, with Twitter, Amazon, and Meta, the parent company of Facebook, announcing thousands of job cuts this month. Companies in interest rate sensitive sectors like housing and finance are also letting workers go. The layoffs have so far not been evident in official data. Unadjusted claims dropped 6,101 to 199,603 last week. Claims in California, the epicenter of technology job cuts, rose by only 302 last week. Big decreases in claims were reported in Florida, Georgia, Kentucky, Indiana, and Texas, offsetting notable increases in Minnesota and North Carolina. All right, so that's the news for today. So housing is slowing down. It looks like the job market still remains fairly tight since the unemployment numbers still look pretty good. So, it's going to be a little while before the unemployment numbers catch up with the bottom lines of a lot of these businesses. So that's not really that surprising. I imagine, if I were to, place a guess on it, I'd probably say that the unemployment numbers will probably start to climb after the first of the year. And then, we'll see what happens going into 2023. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. And I'll see you guys next time. Bye-bye.